I wanted to do something a bit different today, something I haven't done before and something that shouldn't be attempted in 15 to 20 minutes. So always up for the challenge. Here we go. Just want to try and explain how we would structure a portfolio that we might manage. And I'm going to assume a $250,000 portfolio and break it up and explain how we would manage it and what we would do. So firstly, I'll assume this is my portfolio because that's the easiest thing for me to do without all the know your client business. So starting point 250,000, I'm going to subtract $25,000 and keep that aside for, let's say, more speculative trades. So that brings the balance down to 225,000. I would then look to park $75,000. Now, by park, I just mean buy a few stocks that I believe I could just sit on, turn my back on, not necessarily have a stop on, and really, just go for the long term. The two stocks I'd picked there are WAM, which we have been involved in probably 4.5 years now, and we've probably averaged something like a 15% return from WAM. We became involved somewhere, I would think back here, when we first broke through the $2 level. And there's been a couple of cap raisings and so on and so forth, which has given us the very good return. So WAM is certainly one of them. There's capital gain there, plus dividend yield at the moment, 6% fully franked. So I would park some money in that, and we're talking about parking 75,000, so probably 25,000 into WAM. Now, its little brother, WMI, a very recent float or capital raising by the same Jeff Wilson, same manager basically. Floated 28th of June at $1.10. We currently have it on its high at $1.30. We're not showing any dividend yield yet or any franking, but this is Wilson Asset Management micro cap. I wouldn't hesitate, given the performance of WAM, I wouldn't hesitate putting another 25,000 into WMI. So then I need to find another stock or something where I believe that I can just park money. Now, I'm going to bring up the Nikkei 225. This is the Japanese stock market. We're just breaking through this $20,500 point level at the moment. If I bring that back to monthly, there's a 50-year chart monthly of the Nikkei. It wouldn't take much more for us to break through 20-year highs. Now, we can take advantage of that by trading HJPN for Nelly. This is a ETF, and I'll bring it back to weekly, and we'll look at 5 years. And you can see that we've consolidated basically for 12 months and just broken out. So 25,000 into HJPN for Nelly. Now I'm going to go back to the Nikkei 225 chart, bring that back up again. Actually, I'm going to go into a comparison chart, and I'm going to compare the XAO with the N225 just out of interest sake. There's the comparison. The Nikkei for the last couple of years has just totally outperformed us. If we go to a 10-year chart from probably 08, 09 through to 13, we were outperforming the Nikkei, but last 3 or 4 years the Nikkei is cleaning us up, and it is heading towards 20-year highs, or very close to 20-year highs as we speak. The All Ords can't even crack 10-year highs, so pretty keen to get a bit of money into some of these offshore markets. So there's 75 gone. Now the other $150,000, there's 2 ways to break that up. Straight out 10 stocks at $15,000 each to swallow up that 150,000, or position size. Now I'm going to position size, just again for the sake of the exercise, based on a portfolio of 150,000. So I'm not counting the 75,000 that we've parked. I'm not counting the 25 that is for spec trading. The 25,000 for spec trading will be treated differently with other methods of money management. But let's take another stock that I'm pretty keen on at the moment. That is VLW, which is Villa World, but I'll need to bring that back to a single chart. This is weekly 10 years. You can see the general direction it's heading. If I bring it back to 5 years, we have this barrier here at the $2.50 level. We also have dividend yield of 7.49%, 100% franking. So very keen on this one on a break of $2.50. Now, I'm going to assume probably I'd buy a close above $2.50. So I'm going to assume that I get into this stock for a figure $2.55. Now, the way I would look at it is, if I go back to daily and a bar chart, I'm looking for an intelligent place for a stop loss, and this level here, the post-dividend level, is $2.28, $2.29. So I'm going to assume a stop loss at $2.24. So if I buy $2.55 and risk down to $2.24, I've got a 31-cent risk. Now, I'm going to assume that on each trade I risk 1% of my $150,000. So on any one trade, I'm prepared to risk $1,500. If my risk is 31 cents and I can afford to risk $1,500, just very quickly, 30 cents into 1,500, 315 is fine. So I can actually do 5,000 VLWs. So I'm going to buy 5,000 VLW at say $2.55, stop at $2.24. I've got a $1,500 risk. I've got a 7.49% dividend yield, fully franked. Bear in mind there's a bit of a wait for the next dividend. But okay, that's stock number one. Now I have to find another number of stocks where I'm happy to do the same sort of thing. So I could go to South 32. This recently broke again. 310 was about the break. We're at 322 now. I could argue it's a bit late to get on board, but I'm just trying to go through an exercise here. So again, assuming I'm going to buy, let's say 325, I'm going to work out my stop, which is going to be under here. It's going to be about 304. Actually, I'll bring it back to 297. So if I buy 325 with a stop at 297, I've got a 28-cent risk. I'm still risking 1% of my portfolio, which is $1,500. How many times does 28 cents go into 1,500? Again, it'll be pretty close to 5,000. So I add 5,000 South 32 to the portfolio. At a level yet to be decided, I could probably add Bank of Queensland to that mix, and I'm looking for probably a close above the $13 level. I'll go to 5 years. Bit of resistance there at around 14, but I think, okay, for the sake of the exercise, let's assume that I'm happy to buy a break of $13, so $13.10 might be what I pay, and I think I could comfortably put a stop at around $12.44. So I'm going to risk 66 cents. So how many times does 66 go into the $1,500 or 1% of my portfolio risk? I'm going to guess about 2,400. So I could buy 2,400 Bank of Queensland, 5.95% divvy, fully franked. Okay, that's a very quick rundown. On the spec side, I might look at something like ALK in the spec account, and I might be looking for a break of 40 cents again. So I've got 25,000 in the spec account. I'm probably prepared to risk 3%. So that's $750 odd. If I'm going to buy 40 cents and if I'm going to put a stop at 33, I'm going to risk 7 cents. How many times does 7 cents go into $750? You're going to buy about 10,000 ALK. And we take it from there, moving the stops up as quickly as possible. That's the position sizing, and there is always an argument to be had over whether to position size or not, whether to simply take the 150,000 and do 10 stocks at $15,000 each. That's really a decision that you need to make, but I'm just explaining what I might do with my portfolio under those circumstances. The other thing I want to mention, the KOSPI, which is the South Korean exchange. At some stage, very shortly, I'll be looking for an ETF to trade the KOSPI or KOSPI. Simply, right at the moment, the Aussie market is not performing as well as others, so this is probably, in my mind, the best way to diversify offshore. You're still trading Australia, you're trading a recognised instrument on a recognised exchange with all the safeguards that we have in this country, but taking advantage of any offshore movement. Okay, was there any other stock? No, that's pretty much all I wanted to go through tonight. Touch wood, we can have a better week next week, and touch wood, I shall talk to you then. Cheers.